Thank you very much, Adam, for that warm introduction. I will do a bit of an introduction to my panelists, but I will also allow them to give us a bit more context around what it is that they do. To my immediate left is Eva Crouwel, who is the head of financial crime at Hidden Road Partners. They are an international organization that provides institutional liquidity for brokerages and other clients in that space. And to Eva's left is Shawn Barnett. He is the director at Norton Fulbright, South Africa, specializing in the financial services division within Norton Rose. But I would give over to my colleagues to introduce themselves and give us a bit more background around what they do.
Thanks, Jimmy. And thanks, everybody, for coming. My name is Eva. I am the head of, I should actually say, anti-financial crime for Hidden Road Partners. And for those of you that don't know Hidden Road Partners, that is completely normal. It happens all the time. We are the largest non-bank prime broker globally. So we provide market access to exchanges and venues, but we also provide an array of traditional finance products. I have been doing anti-financial crime for the better part of 16 years, and in the last 5 of those were dedicated to particularly cryptocurrency crime. So.
Thank you very much. Shawn Barnett, as Jimmy mentioned, I'm a director at Norton Rose Fulbright, specializing in financial markets and in particular in derivatives and related services. I think I've dealt with probably 80% of the people at this display. The OTC market is relatively new, or the regulation of it is new, and we have, as a firm, really focused on it and try to help our clients to get to the bottom of how to do things properly. And I think that's probably going to be the basis of much of the discussion today. Maybe not something that many people want to hear, but I hope as this market progresses, something that more and more people are starting to think about.
This is usually the part of the conversation at these sorts of events where people don't want to listen until they have to listen. And I'm looking into the crowd and I'm seeing some familiar faces that I've spoken to about regulation. And regulation doesn't just sit within financial services. It sits in any financial assets like crypto. I'm seeing some of the biggest crypto players sitting here with us that are on the right side of regulation, because the reality is when you're dealing with client funds and you're dealing with assets that do not belong to you, as financial markets and derivatives are, you need to act appropriately as a service provider, and remember that that is exactly your role, is to be a service provider and not to be anything more than that. And I think from a regulatory standpoint, personally, I've had this conversation for more years than I care to count. And I thought this year would be fantastic because I don't have to do any of the talking. I've got 2 lovely individuals from different points of view to give you exactly how it works in real terms, from a legal perspective, from an institutional and an operational perspective. These companies deal with the brokerages that you visit. They deal with them in consulting for them, in offering them services, and in making sure that they deal with compliant individuals. And I think that's where we start the conversation. I want to start the conversation with you, Shawn, around the ODP licensing. This is something that, for people that don't know just how long you've been at this, I stand corrected, but I believe that the first ODP license that was granted in South Africa was under your consultation, and it was through the Norton Rose team, and it was after, I think it was more than a 2 or 3 year consultation with the regulator. And from that point to kind of where we are today, let's perhaps start by saying, how crucial has that licensing become for operating in South Africa?
Sure. So just to be clear, that is on the non-bank side. So the banks have been getting ODP licenses for quite a while. On the non-bank side, so the CFD providers, the FX providers, we saw quite a bit of reluctance initially. I think people had a misunderstanding around when ODP licenses are needed. And that is largely because we came from 2018 to 2019 from an unregulated environment where the issuing of derivatives was essentially not regulated at all, to an environment June 2019 where you needed a license to be able to issue or sell derivatives in South Africa. Now that's an important distinction in South Africa, because how the market then started evolving is many of the brokers decided, if we built a structure where we don't issue in South Africa and we merely refer clients to offshore providers that actually issue the contracts, in those circumstances, if you do it correctly, you don't need an ODP license. You need a financial services provider license under the FAS Act, but you can operate in that way. And I think many people here operate that way. I think some of the participants here have ODP licenses. And maybe let me then touch on the importance of ODP and how that has increased recently. Now, I have seen over the last 18 months, a number of brokers who were quite happy to deal with this type of business on a referring broking model, where they were getting South African clients and referring them offshore, who are now wanting to get ODP licenses in South Africa. And one of the principal reasons for that is, firstly, it comes with the fact that you can tell your clients you are properly regulated in South Africa. You have all the client protections that we see in other jurisdictions. But more importantly, the referring broking model doesn't allow you to take cash deposits in South Africa. And that is what many people still don't quite understand. Exchange controls restrict the ability to take RAND deposits in South Africa if you're referring clients to offshore brokers. If you have a South African ODP license, you can take RAND in South Africa and potentially hedge yourself offshore within your group. So that has been a very important distinction in the last sort of 18 months. People have been moving more towards the ODP licenses, and I'm currently working on a couple where they've decided that it makes financial sense for them to be able to go to clients and say, listen, we're locally regulated, we can take your RAND deposits locally, and then from there they can, of course, hedge with liquidity providers all over the world, subject to certain exchange control restrictions, but that has just made their business easier.
Now, Eva, Shawn speaks of this from the perspective of the letter of the law, as he interprets the legislation that is out there. I want to look at it from the prime brokerage side. Hidden Road, I've dealt with Hidden Road personally, has some of the strictest due diligence that goes into onboarding a client before you even offer the services. Take me through why that is important in the context of regulation and fraud and trust, because of the fact that you don't deal with just a retail client. You deal with institutions that want to deal with, well, that want to have funds come through you.
Yeah, and I think that is an extremely important thing to emphasize, is that the world of institutional prime brokerage, which in a large way contributes to the existence and growth of the subsequent retail market, right? Because if you want to have a retail market, you need liquidity. That liquidity needs to come from somewhere, and those are usually your large market makers, etc. In that model, the focus area of a prime broker is one that is about trust. I always jokingly say that's what we sell. We don't sell cross-margining, although we also do that. We don't sell credit, although we also do that. We sell trust. And for a large part of the traditional financial institutions in that space, trust comes through regulation. And trust comes through being able to evidence that you have and uphold golden standards when it comes to your onboarding, when it comes to the safety of your product and the safety of your platform and your brokerage. And a large part of that comes through having licenses and being regulated in the markets where you operate. We have always said, compliance by design. We are regulated everywhere we do business. We have a few of what's called the hardest licenses to get. We have the MiCAR, which I personally went through. I can tell you that's not a joke, even if you're a seasoned compliance professional. We have the AMLD5 in the UK. There's only 51 of them given at the moment, so it's about a 2% chance that you get it. We got it, and the reason we have it is, A, we are extremely strict, sorry, but B, the reason why we are so strict is because trust, reputation, and regulation, they go hand in hand. So for us, being attractive as a prime broker to some of the largest names in the industry is exactly because of the fact that we uphold such high standards.
Shawn, I want to take a look at what happens when it goes wrong, because the conversations and the advice that's given is merely that, advice. At some point, the client, whether it's a Hidden Road client, a Norton Rose client, any other client, has the option and the discretion to take on that advice or to not. And in the event that something happens and a client has not taken on that advice, and I want to look at it in the context of brokerages, where brokerages find themselves with funds that are withheld or frozen, so to speak, by the central bank, not because the central bank has a vendetta, but because they are not compliant.
Correct. Yeah, so we currently probably involved in about 3 or 4 FSCA investigations into various ODPs, or at least brokerages that act as ODPs without ODP licenses. So what these things tend to end up becoming is an investigation around whether the relevant brokerage put itself out there as an ODP, but secondly also whether advice was given, because very often these brokerages say that we're not giving advice, we're merely referring you to other people, but we're not advising you to trade, we're not helping you to trade. So there are many instances that we found currently where we have brokerages out there with often just an FSP1 license with no advisory element to it, but they are clearly through their network of brokers or their network of IBs giving clients advice. And it only takes one client to complain to the FSCA for there to become for there to be an investigation into that particular person. And at the moment, we've seen KIs on these licenses, and the problem with key individuals on many of these financial services provider licenses are that they are essentially KIs for hire. Quite often they don't know the business, they don't understand the business, they are just there to act as a KI. And it's those people who then often bear the brunt. They get disbarred, they can't act in this place, act in this capacity again. So there's some real consequences to the brokerages doing this in South Africa without licensing. The point Jimmy mentioned around the blocking of funds, and again, we've had a couple of matters like that as well. We've had brokerages that took cash deposits in a referring broking model. In other words, where they had no ODP license in South Africa, but were merely referring clients offshore. And those cash deposits were blocked in South Africa because the Reserve Bank said, and quite correctly, that when an individual is investing with an offshore institution, it has to take his money offshore. It can't keep it in South Africa. And those people there are some big numbers involved, were unable to get those cash offshore because the Reserve Bank essentially said there was non-compliance by those individuals with exchange control. And the brokerage, again, has no basis on which it can transfer the money offshore. So there are some real-world consequences to not complying. I think the fact that not everybody is currently under investigation is simply a matter of the FSCA often not knowing what happens within the entire market. But there are more and more complaints that finds its way to the FSCA, and almost without exception, every one of those end up in a full-scale investigation by the FSCA into those people. So it is very important. I think all the larger brokerages that have been here for a very long time have done this due diligence up front. They've looked at what they do. They've got advice around whether they're doing it properly. And when those investigations come, we can deal with them. The problem is the ones that start a business first and then start looking at regulation. That's where we find there's some real consequences for them.
Shawn, I want to stick with you on that very last point. I had a question in one of my earlier panels around how do I, as a retail trader or as an investor, then identify which brokerages to be involved with? What are some of the red flags that I need to be looking out for?
Sure.
And I suppose you can take it from a compliance perspective. And then, Ava, I would like you to weigh in from an operations perspective. Sometimes a institution circumvents certain things around how they offshore or how they move their funds or how they handle their operations, where if I had to ask a question as a potential investor, that jumps out and says that broker might not be operating within the confines of the law, as it were. Obviously, laws are different in different jurisdictions, but perhaps, Shawn, if you could just take us through, just from your perspective.
Sure. If I was a retail client in this market, which I'm not, then the very first thing I do, I would look at what regulations or what licenses does this institution have. Now, many of them, in fact, most of them would say that they are a financial services provider under FAS. Now, the inquiry shouldn't stop there. If they're giving you advice, if you believe at any point this brokerage has given you advice, you should ask yourself, did they ever ask me questions around whether this is an appropriate investment for me? Did they do an assessment of how I should be looking at these instruments? Did they do any record of the advice they give me? And I promise you, in almost 90% of those cases, that does not happen. So retail clients should definitely look at what licenses they have, but should go a step further and then ask themselves, what are these people doing? Are they giving me advice? And then ask them questions. Are you authorized to give me advice, yes or no? Where are the people calling me from? Are they calling me from South Africa? Are they calling me from different jurisdictions? I mean, again, to digress for 1 second, I've got a client at the moment who was in Brazil. There was a Cape Town-based brokerage that was selling this client products from brokers from all over the world, from the UK, from America, that they were calling him on a daily basis, getting him to invest more, but the brokerage was based in South Africa. And at that point, if you have this many jurisdictions involved and you don't actually see the South African entity doing much, that should be a red flag. Then you know that the license is being used for other reasons.
Eva, from an operations standpoint?
Yeah, I think I echo what Shawn is saying. As a retail consumer, I would personally, from experience, never go with an unregulated broker. It's as simple as that. I always say,
why?
Because a fast buck is an expensive buck. And that's the reality. To Shawn's point, it sounds fantastic, and it sounds usually your path to money is much quicker, right? Because these guys, they're not that fuzzy with the KYC. They give you advice, they help you through the process, they do everything. It's easy to deposit. You get massive yield, etc. Guys, but what also can happen is that those funds can be confiscated tomorrow. And I have had circumstances where clients of ours have had their money locked up, not through us, but they can go direct through another broker, where they've had their money locked up for years. And that's what we're talking about. It's not like you can phone the police and say, please give me back my 10,000 rand. You're going to have to sit it out and wait until that investigation is done, until Shawn's done with his work, and then you might get your money back. Or even worse, you think you're going with a trusted broker, and it turns out that it's a scam, and they take your money and they run, right? And especially, we all know in the crypto world that is prevalent. I used to work with Christo because I did this same trick at Luno, and I want to say 98% of the cases I saw at that time were retail scams, and it boils down to something that is both simple and complex. If you want to invest in any type of way, if you want to trade in any type of way, you need to do a bit of homework. Right? A fast buck is an expensive buck. You need to do your homework. Understand what licenses mean. Understand what financial products licenses allow to be traded. Right? And understand the differences. And then go and approach your broker and ask for their licenses and ask for their RAs. And recently, FSCA has issued quite, I think 2024, another notice around, guys, be careful about fraudulent REs, because they're there and they're prevalent, and the market, it's absolutely flooding the market at some point, especially, again, in the crypto space. So, do your homework, go with a broker that has a good reputation, that has been around, and does their homework. And if KYC or if onboarding feels a little bit too easy, that's a red flag. You mentioned before, we are hard. I've had clients come to me and said, you're harder to get into than Harvard. And there's a reason for that. Due diligence is a process where you establish trust and where you establish reputation. And only if you're satisfied with that, should you be trusting people with your money. It's as simple as that.
I think you mentioned something quite important, Eva, that we often don't realize as traders, as investors, as those that deal with brokerages, as the consumer on the end of the value chain of the transaction, is the service provider has to prove to you why you should put your money with them, not the other way around. It's not the service provider doing you a favor by allowing you to be a client of theirs. You are the client. You are entitled to ask those questions that you feel you want the answers to. And for as long as those questions are not asked, you're the only one that's disadvantaged in that process as an investor and as a trader. For as long as you're quiet and you're saying, oh, I assume that these things are in place, you are the only victim in that situation. So I think from a regulatory standpoint and from a compliance standpoint, you've heard both of my guests say that the more questions that you have, the more research you do, the more homework you do, the better off you are. At the end of the day, it's the same as any other financial transaction you enter into. When you're looking to buy a house, when you're looking to buy a car, it doesn't really matter what the financial transaction is. You go and you do your homework, you go and you do extensive research on the things that matter to you. And finding a partner from a trust perspective, a regulation perspective, a funds perspective should be no different. You shouldn't just wake up and say, there's the brokerage, happy we haven't done any research, let's just go put our money there, because at the end of it, that's where the other conversations come back, where something's gone wrong and now suddenly you want to then go and do the research that should have been done ahead of time. As we wrap up the conversation, Shawn, perhaps you can weigh in on regulation changing in South Africa. You mentioned, of course, at some point these services were not regulated under FAS, under the Financial Markets Act that was introduced in 2008, that these products are now regulated products. When things like regulation changes, I think we often forget that it is partly the responsibility of the service provider to notify a client. The same way, if Hidden Road changes its operating procedures and its client agreements, you have to notify the client and say, hey, your customer agreement or your relationship with us now looks different. Shawn, take us through the legalities behind the obligation that sits there.
Sure. So Conduct Standard 2, which is the conduct standard dealing with getting a license, specifically deals with the content of client agreements. And one of the requirements in that conduct standard is that, firstly, your client terms must be simple to understand, you must get agreement for changes, and certainly you must inform clients of any material changes that happen. Now, I am weekly looking at client agreements that are materially non-compliant. I think the default position for most of these providers, and I think it often comes from bad experiences that some of the brokers have had with particular clients, is to give themselves immensely wide discretion to essentially do whatever they want to do in any circumstances. And that includes closing open positions whenever they want, doing the valuation of reference assets essentially on their own untested models without any reference to objective criteria. Now, those things, if they are going to be tested against treating clients fairly, is going to fail. The fact that the FSCA hasn't gotten to look at every one of these client agreements doesn't mean they are compliant. I think if there is a dispute that ever arises, the vast majority of client agreements I look at are materially non-compliant with the existing regulations. Now, I think those regulations will evolve as we get into the Conduct of Financial Institutions Act eventually. So once COFI becomes law, and it will essentially replace the FAS Act, and it will replace numerous other financial market legislation, the conduct standards we'll see under that will be very treat your customers fairly focused. And I think this industry as well, because of some of the issues that we've had over the last couple of years around some incidents around clients potentially not being treated fairly, I think we're going to see conduct standards that's going to make that a core focus within this industry. So the faster we get to a place, maybe where the insurance industry is at the moment, I mean, they've had pain for many years where the regulator has forced them essentially to start treating clients better. I think we're heading that way within this industry as well.
Ava, I'm going to leave the last word with you, and it's something that you brought up earlier around scams and the scams in the crypto space, and how do you, as a retail investor, an institutional investor, it doesn't really matter who you are in the value chain, how do you move forward with confidence in an industry where people are often taken advantage of, not just by their own peers, but by institutions that have the power to do the right thing? How do you look forward and say, this is where the future of this industry goes, And this is how we protect those that operate in the space.
Yeah, I think regulation does go a long way, but the problem is that it's almost like a whack-a-mole, right? As soon as you whack one of the scams down, there's another one that comes up, and the reason is, unfortunately, because crypto is extremely volatile and it's an extremely easy access product. I don't think necessarily the solution there is in making the product harder to get. I think a large key component of it is really to start embedding more of a sense of reality of when you're dealing with crypto. Right? I am yet to come across a traditional finance product that gives an 8% yield year on year, month on month. Right? Anybody in this audience that has it, let me know. I will immediately quit my job. Because it's not the economic reality, right? Whereas we're now at the point where crypto's become mainstream, right? Financial institutions, large financial institutions, institutional finance has entered the building. And what that means is that we should start looking at crypto as a very mainstream economical product. And with that, also with economic yield that is reflective of a traditional finance product more and more. And with that mindset, if you look at it like that, then you can immediately spot, and I'm gonna kind of like exaggerate here, but you will get the idea, that if somebody has a flashy Instagram page with way too many emojis in the text and drives a red Lambo and has like their nails done up and red lipstick on and says that they're making $150,000 a month out of crypto, they're lying. I don't know how to say this otherwise, guys. It is a scam. Right? If that same person would tell you that they would get 5% interest on a standard bank account, you'd all walk out of the room. It's kind of like, dude, no way. But now all of a sudden, because it's like a crypto scam, you believe it. So I think with the era of institutional finance entering the room and really the industry as a whole growing up, consumers also need to get to the point where we're all acting like grown-ups again and understanding that there is such a thing as monetary value, and it is now coupled to a crypto asset, which means that you should be even warier when you're seeing these types of returns. Yes, Bitcoin is amazing, and yes, it's doing extremely well, but the reason it's doing extremely well is because it's starting to be funded by mainstream traditional finance products and being intertwined with that. So the days of, the massive yields of 300%, you should have been around in 2015, basically. So nowadays, it's consider it a mainstream product and look at it like that. So do your due diligence on whoever is trying to give that product to you. Right.
Thank you so much for that, Ava. Folks, we have unfortunately run out of time. I'd like to thank everybody for joining us. We do not have time to field any questions, but please feel free to engage with the panelists as we come off stage. Thank you once again for your attendance, and if you do have any questions, we'd look forward to seeing you afterwards. Thank you.